Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we also have our econ show. So I am wearing the same shirt. I am filming this the same time as the EIA show, which is something that we haven't been doing, which has been nice, not gonna lie, for both myself, our producer, as well as the people supporting us. But I will be in the city tomorrow. Was asked to speak at the New York Alternative Asset Management Roundtable. So I'm excited to do that. So we're gonna film this here, and a lot of these topics will absolutely show up at the at the conversation. So if you're in New York City, it's from 5:30 on at 90 Park in New York. So with that being said, the 5 segments that we're gonna do today, we wanna look at the geopolitical issues because they're continuing to mount, some good, some bad, to understand what are some of the different backdrops. Then we're gonna look at the US leading indicators and how rates moved higher again. As we were speaking, another weak auction has sent rates back to the highs. And a lot of leading econ indicators, especially on the trucking side, are showing that things are getting much worse. And that's what we've been talking about as kind of that September into October period, is that pivot down, which we think is going to accelerate. And then when you look at then in the third segment, we're gonna go deeper into housing, inflation, and how those leading indicators on the housing front, again, are showing how there's more pain to come on the economic side. And then we're gonna look at the ECB and where their balance sheet is and the mounting pressures that they're facing. And even though even as they face them, they're still not taking, I think, the action that should be taken. And it's obviously that quantitative tightening issue and those problems where they have this hesitancy to tighten because of the concern of what it would do to debt, especially on the Italian side, which we'll talk about more further. And then we're going to look at China and what we know so far from Congress, but also they keep delaying economic data. And there's probably 2 reasons for that. One, they don't want to distract from the Congress, especially if it's bad data. They want people to focus on it. But it's also, are they trying to figure out how they're going to create a message behind that and how they're going to try to show the data with what is coming out of the Congress, which I think is going to be very important in general. So with that being said, I've promised to go through Libya again. I will try to do it briefly just because we have covered it extensively, but just to bring us back into where we sit at the moment. Here you can see the Turkish troops, drones, how they remain in Tripoli. There is a presence of Turkey here, and this is coming by courtesy of petroleum economists. And here you can see right in this point, there's a lot of activity. So Turkish President Erdogan says Turkish companies are going to start oil and gas exploration in Libyan waters. It hasn't really specified sites, but remember, there were 4 blocks in the Gulf of Sirte that are being explored by BP and NE, which is why Italy has gotten so, I don't want to say aggravated, but annoyed in terms of, well, what is happening? And then when you look at Greece and Israel and how this starts to move into who owns what in this region, because there's a lot of crossover on what areas are identified and also which governments are in power, because there is a stress between Erdogan and Turkey in general, because they do support the Muslim Brotherhood. How that actually comes down to, well, what is Haftar saying? What does Egypt say in terms of some of these different structures? So far, it's in words only. And the reason why is because where are they going to go? Because when you start looking at the disputed waters in the region, here you can see what Libya claims, but then the Egypt-Greece agreement creates this essentially this thoroughfare, which also cuts through Libya and what would be the Libya-Turkey agreement. So the question will be who has what and where. And then here you can see what Turkey is claiming and how that bleeds into where Cyprus is, and Turkey, again, moving out, cuts into not only Greek EEZ, Cyprus EEZ, but also starts to bleed into where Egypt sits in that level. So it's going to be important to look at that corridor And looking at it a bit differently, you can see that Turkey and Libya corridor cuts right through Greece and also shades over into Egypt. Now, there is an agreement that can be made where Egypt would be the minority partner. They could say, look, you can be on this little sliver, but Egypt has made an agreement, going back to the previous slide, Egypt has made an agreement with Greece that little sliver right there would fall under their joint exploration. So again, that's going to be really important when we look at where things are being done, how they're being done. And then when you look at Lebanon and Israel, there was a big breakthrough in terms of what has been happening between the two. And I think it's important to look at it this way in terms of the Lebanese and Maritime border. So when you look at the Israel line, which is that red line, and then when you look at the Lebanese southern border maximalist claim, that blue line, it's a matter of, okay, well, who falls where? And when you look at it, they made an agreement to essentially split the difference. And it's going to give Israel the ability to continue to explore in these areas that we know have very much extensive value. And it would give cash back to Lebanon because they're going to have a sharing agreement, which is, it's interesting when you look at Israel and Lebanon. Obviously, when you think about the Houthis, what is happening between that level, this is a fairly big breakthrough when you consider how Israel and Lebanon sit. And I think it speaks greater towards the pivot and the shift in the way Lebanon not only views Israel, but the way they view the Houthis, the Iranians, and again, how they want to be done with it. They're tired of the infighting. They're tired of we've shown on this channel multiple times the failures that have happened, how it's resulted in deaths and explosions and other problems for the Lebanese people. And they're like, look, let's make a deal with Israel. They've already shown that they can do it, looking at the different places, and how can they come with some sort of agreement. And the Lebanon's formal Southern EEZ and where they're trying to show. So I think it's a very good breakthrough, if you will, in terms of where things are going on that sea border and how that opens up Lebanon to share in cash flow as Israel explores and then turns on the Kana prospect, and how that could actually lead into additional not only natural gas availability, LNG, and underlying sales. And I thought this was a really good statistic when you look at the Iranian discontent, because we've been covering it so much in general. So, and this is following statements as of July 2022. So when you consider when the issues really started to take precedent and really start to make strides, there's already this problem. Iranian youth do not see prosperity in their futures. 66% agreed. How do you regard Mr. Rassi, the president? 62% dislike. Iranian youth prefer to emigrate to other countries rather than live in Iran. 61% agree. What is the main purpose for enacting the cyberspace protection bill only to censor? 50% agree. So you're starting to see, again, these pressure points, and it's only gotten worse and pivoted the other way. But there's a massive unemployment rate for this specific level of young adults, and that's the underlying problem. When you start looking at people that feel disenfranchised, left behind, and now persecuted against, you're starting to see the rise up happening. Iran has lost a certain amount of prestige if you think of Syria. When you start looking at some of the other areas in Lebanon, when you look at the deal they just did with Israel, when you look at Syria, Israel has been bombing a lot of their key locations. So it'll be important to look at, what does Iran do from Yemen? Do they try to launch a new attack? Do they try to show some sort of relevance coming from that region? We do know that Iran has been supplying Russia with suicide drones. Those have been deployed into Ukraine. That has prompted the EU to increase their sanctions against Iran, which again is going to hurt their ability and start to tighten down, because they've been exporting, I don't want to say with impunity, but they've been exporting well above where they should be based on current sanctions, and that's something that is going to continue to go but with Europe starting to get more aggressive, that could definitely put a kibosh on some of these things. Now, coming back to Russia, Russia has declared a martial law in the 4 regions that were just made a part of Russia. For anybody that's been paying attention, that isn't surprising, because now they are showing control, and they have officially stated that these 4 areas fall under the protection of Russian nuclear equipment. Again, not a surprise, but there's continuing back and forth. You can see that the Russians have tried to make a advancement. So far, based on the geolocated data, Ukrainians have been able to repel and maintain control. And you can see a lot of these different flashpoints, and the yellow areas are points of contact, where right now it is still up in the air. Early indications have shown that the Ukrainian forces have repelled the attack, but based on the ISW, they really won't claim one way or the other until they can actually see who is left standing, where are the positions at that point in time. And the Ukrainians continue to make strides if you look at some of the attacks that have been made into Russian territory. And then as a pushback after the Crimea Bridge, the Russians have launched multiple missile attacks into Kyiv, into other key areas as a means of letting them know we're still here. We know what is happening. But on the other side, when you look at the fact that Russia's using Iranian suicide drones, it's like, well, don't you have your own missiles? Don't you have more intelligent missiles? Why are you using something like this? Which calls into question, what is their preparedness, prep? What kind of availability do they have? What kind of ammunition do they have? Which is, I think, some of the bigger issues when you look at some of the data sets. This is just zooming in a bit. Here you can see that there's been multiple Russian and Ukrainian sources reporting that Ukraine forces captured several entities across this southern front. And I think it's important because when you look at the river coming down, how the Ukrainians have continued to essentially create and try to push on multiple fronts to collapse this under Ukrainian control, and then they'll have the natural river as a means of separation, which is a very important stride when you're considering, the logistics of it all and how that continues to move forward. Ukrainian forces likely retain control over Yamkaviv and Torsky from October 11th and 12th, which again is pivotal just in terms of the importance of it as a logistical center. So again, some of these are very important just on a logistics basis, and it seems to be continuing to move in the Ukrainian favor, especially when they've been able to repel a lot of these counterattacks, which is imperative when you're looking to establish a new line of control and continue your advancement. Now, when we look at Europe, and I think it's important to remember as we're, again, hearkening back to the winter, where we are with what is happening within Europe in general, what is the most used energy sources in Europe. And here you can see that natural gas remains obviously a large one, and so does oil. When you look at Ireland, when you look at Spain, Portugal, Germany, there is obviously a very large component that relies on the oil front. And when you think about oil, you have to consider, well, that's a lot of distillate. And that's why distillate is so important when you're looking at the market in general, as we discussed in the EIA show previously. Then when you look at the size of the metal shortage Europe will face to meet its green energy transition. So when you look at the transition in general and the shortages, Europe will need 35 times more lithium, 7 to 26 times more rare earths, 2 times more nickel, 1/3 more copper. So estimates are based on a study commissioned by Metalex. And it just gives you an idea that as they try to replace these entities, you're just going to drive up prices that are going to replace a lot of these components, which is going to drive up pricing and create a problem when you look at how quickly does that green pivot move. Is it going to be possible to have that kind of aggressive pivot? And if so, what are some of the impacts? So then when you start looking at the dollar surge, the dollar value is at the highest level since 2000. It continues to remain at about 113. It has appreciated 22% against the yen, 13% against the euro, and 6% against emerging market currencies since January. But when you look at how countries have tried to react, they're trying to protect themselves on the inflationary side, and they're trying to manage that currency, which is why you've seen those FX reserves come down. So in many emerging and developing economies, foreign exchange intervention has limited currency depreciation, which is why you've seen those FX reserves drop. But at some point, they're going to have to yield because they're not going to have the same FX capacity, which is going to force their hand further and create additional weakness, which is something that hasn't really happened yet. But we see, which is why we think there's going to be that snap that's going to send the dollar to 115, 116. Not so much because the Fed is being so aggressive, but because the other currencies are doing so poorly. So approximately half of all cross-border loans and international debt securities are denominated in US dollars. While emerging market governments have made progress in issuing debt in their own currency, their private corporate sectors have high levels of dollar-denominated debt. As world interest rates rise, financial conditions have tightened considerably for many countries. A stronger dollar only compounds these pressures, especially for some emerging markets and many low-income countries that already are at a high risk of debt distress. Again, this is quoted from the IMF. For those that have been watching us, I could have written this myself. In these circumstances, should countries actively support their currencies? Several countries are resorting to foreign exchange intervention. Total foreign reserves held by emerging markets and developing economies fell by more than 6% in the first 7 months of the year. And based on what we've seen so far, it's continued to deteriorate, which is going to be something to watch ahead. Major forecasts remain below IMF. Again, I'm not the only one to say this in terms of IMF still being too high. Others agree, and you will see more downward revisions. Global PMI breadth, global PMIs below 15% are now at 60%. So 60% of countries are in contraction. And as we've been saying, we expect that to accelerate as the developed markets slow further. Developed markets unemployment rate deviations from pre-pandemic levels. So unemployment rates still remain very low, and a lot of that is driven based on the lack of participation rates, which is keeping that artificially low, but at the same time opening up the ability for central banks to continue to raise rates. And then when you look at can we afford the fiscal splurge, you get an idea that the answer is no. When you look at the amount of debt that has been issued, we're at the same levels versus World War II. And it's just a problem when you look at where rates are going, where that papering the town. And the issue is many countries are still running deficits. So you're still technically have a fiscal splurge. Nobody is tightened to the point where on the fiscal side, clearly, not so much on the monetary side, you're starting to see that tightness, but nobody's on the fiscal side. We haven't seen austerity. So we're still seeing that come through. And central banks absorbed COVID debt, and you get an idea of the amount of central bank assets per percent of GDP. Obviously, this is going back to 1696. Take that with a grain of salt. But you get an idea of just where we are and how involved the central banks have been to try to stave off where we are at the moment and why we think things continue to get worse. Now, when we start looking at U.S. container import volumes have finally started to fall off the proverbial cliff that some in the industry have been predicting for months, i.e. freight waves, Freight Alley have been talking about that drop. And you can see that the import volumes continue to fall. And we now had the worst September since 2016. Total square footage of lease signed annually, you can see that there has been a drop. Major markets, non-major markets, all of this, again, it's just when you look at activity from a housing side, from a commercial real estate side, all of this is showing continuous slowdown. So you're not only getting it from the economic leading indicators in terms of shipping, but you're also getting it from the real estate side. And then the container freight benchmark rates coming down with the supply chain stress tracker continuing to fall, but at a steady rate. But there's still other problems. Transportation is just a piece of it. When you look at prices and labor, that is still, especially prices, that still puts a lot of stress on the market. So as you have this continuous stress, now we turn to it and we see corn yields have flatlined and started to roll over. As the U.S. drought monitor, 81.8% of the USA is now abnormally dry, the most in data back to 2000, replacing the prior high of 80.8% from July of 2012. However, area covered by moderate or worse drought was higher in 2012. So again, the fall winter is going to be pivotal to see how much we can get that, because when you look at the deep red in 2012 versus 2022, you have some of this focusing side, but again, this is not a good thing. It's good for harvest because it's drier, you can get out there. This is not good for plantings. This is not good for winter wheat, where we continue to have that pressure. Bond fund flows across regions. Here you can see emerging market bonds continue to move down. And then the JP Morgan Global Total Return Index on the emerging market bond side continues to move lower, which as rates are going up, we expect this to continue to be the case. 10-year trade-weighted interest differentials. You can see Japan, the yield control curve and a global inflation shock, which is, again, something that the market is actively pushing against, with the U.S. dollar and Japanese yen exchange rate moving to levels not seen since the early 1990s. FX intervention in Japan is futile. Yen weakness is driven by a massive move in rate differentials against the yen, which is that red line, with the yield control curve anchoring Japanese yields as the global inflation shock pushes rates up. Only an end to the YCC will turn the yen, which is what we've been talking about. And the US dollar is at its strongest relative to the Japanese yen since 1990. So at some point, the market's going to keep pushing on that string until the BOJ essentially yields. So then when we turn to the lagging rolling 12-month sum of the not seasonally adjusted trade balance, it's hard to overstate the magnitude of the shock hitting Europe. Japan and the Eurozone are both big exporters, and they both import lots of energy to produce exported goods. But again, the drop in, it's just, you're seeing the huge shift down in trade balances driven by cost as well as lower exports. And then the imports invoiced in dollars percent as of 2018 imports, you get almost 85% of Indonesia, 80% of Brazil, 80% of Korea, 70% of Japan. So when you look at that differential between the two, you get an idea of the huge overhang that is created with a strong dollar versus the weakening of these currencies. So that's what we have for you on the global backdrop. In the next segment, we're going to go deeper into the U.S. and the Fed and where rates are going to go from here.